Now, closing journal entries are just basically a type of journal entries. In Chapter 3, we talked about adjusting journal entries. Chapter 2, we talked about general, regular journal entries. Now, with a closing journal entry, before you get into the hows, you need to realize that there's two types. And you can take an account and put it in one of these two categories. The first category, we're going to call it permanent accounts. And the second type of account, we're going to call it temporary accounts. And sometimes you will hear another name for permanent account. You'll hear the term real account. It's the same thing as a permanent account, it's just a different terminology. And for temporary accounts, you will sometimes hear the word nominal. Okay. Now, in terms of examples of a permanent account, all of your assets, your liabilities, your equity accounts such as common stock, let's see, what else? Common stock, retained earnings are all examples of permanent accounts. So permanent or real accounts, assets, liabilities, common stock, and retained earnings. Now, examples of temporary accounts would be, first one, revenues. Second type, the second example would be all expense accounts. These are expenses. And dividends. Dividends would also be considered a temporary account. Now, this is in your reading. I'm not sure exactly what page, but you should have already read that or reviewed that in the notes. Now, a new item or new account that we haven't talked about earlier in the semester is the income summary account. This is a new account. This is also an example of a temporary account. Okay. Now, the key to remember is that you will close at the end of the period all of the temporary accounts. These are the accounts that will be closed. You do not close the permanent accounts. You only close the temporary accounts. Okay, so we got that part down. Next part, how do you do your closing entries? Well, to do your closing entries, you must first start with the financial statements or an adjusted trial balance, since this financial statement was prepared from adjusted trial balance. Now, here we have MSK Inc. We have our revenues of $6,000, rent expense of $700, salaries expense $1,500, supplies expense $600, total expenses $2,800. So you subtract your expenses from your revenues to get a net income or net profit of $3,200. Now, in terms of our temporary accounts, that's what we're going to close out. Revenues is an example of a temporary account. Expenses, all the expense accounts are an example. So what we're going to do is we're going to close out those accounts first. To do this, what I recommend you do is use the general ledger, or you can create T accounts for your temporary accounts. And here you'll notice I have a T account for revenues, rent, salaries expense, and supplies expense, all from the income statement. Now, what you want to do when you close that account, the goal is to make the temporary account balance equal 0. That means you want it to be 0, nothing, so anything that's in there, you want to take it out. So that when you start the next period, you'll be starting with clean balances, and then when you're trying to track all the revenues and expenses for the following period, you'll start off with a clean slate. So to make that happen, you'll see here that revenues has a normal balance of credit. So if we want to get rid of it, we want to what? Make sure that we debit that account for that same amount. Now, if we debit revenues for $6,000, to bring it down to 0, we're going to have to credit something else. Now, what we'll do is, in the meantime, we will credit it to the income summary account. And you'll see why we're going to put it there as a temporary holder. Now, what I'd like you to do is make sure you have a sheet of paper. You can kind of follow along with me. Now, the temporary accounts will occur on the last day of the period, last day of the year. So if you have, let's say, I don't know, This is year-end December 31st. Just like the adjusting journal entries, you will use the same date, the last day of the period. The adjusting journal entries were prepared prior to preparing the financial statements, while the closing entries are prepared afterwards. So you're going to pull up that general journal that you had, your regular journal entries, your adjusting journal entries, and you're going to add to it. So the first one will be a closing of the revenues account. Now again, we're going to debit revenues for the 600. I'm sorry, not 600, 6,000. 6,000. So we're going to debit that 6,000, and then we're going to, let's see, let me move this over a little bit. Okay. So on December 31st, we're going to debit revenues. This is decreasing the revenues account. So we're going to debit at 6,000, and then we're going to credit income summary. And we're going to credit that, what, 6,000. Okay. Now, after we credit that 6,000 income summary, we're going to look at our next item. Oh, I'm sorry. We're going to post. So we're going to post the 6,000 here to the revenues account, and then we're going to credit income summary for the 6,000. And next, we're going to close out our rent expense, salaries expense, and supplies expense. So we have 700 in rent expense, 1,500 in salaries expense, and 600 in supplies expense. So what must we do to get the balance down to zero? Well, this has a $700 debit balance. So to bring it to zero, we're going to have to credit it for 700. And we'll do the same thing for a salaries expense. We'll credit it for the account balance, and we'll credit the supplies expense for the account balance of 600. So if we credit something, because we're doing a journal entry, we must have a what? A debit and a credit. We need to do what? Let's see. 12/31 is the date. We're going to have to debit some account, and we're going to go ahead and stick with the income summary account. So we're going to go ahead and debit the income summary account. And I'm going to hold off on the amount, and you'll see why in a few moments. Okay, so rent expense. Rent expense was the first one, and we had a balance of, let's see, 700. So we're going to credit rent expense for 700, and the balance for salaries expense was 1,500. And we had supplies expense, and we're going to credit that one as well for 600. Okay. Now with your calculators, 7 plus 6 is 1,300. 1,300 plus 1,500 is 2,800. So that will be the amount of our debit, because remember, we want our debits to equal our credits. We want our left side to equal our right side when we're journalizing. So income summary will be debited for 2,800, and we'll credit rent expense for 700. We'll credit salaries expense for 1,500, and we will credit 600 to supplies expense. Now, this is the journal entry. After we journalize, just like the adjusting journal entries and the regular journal entries, we need to post it. So we're going to post our 700 credit to rent expense, our 1,500 salaries credit to salaries expense, and our 600 credit to supplies expense. And then add those up. We're going to put the 2,800 on the debit side of the income summary. Okay. So we posted all of these accounts, and right now I don't have the account numbers, but of course, after you post an account, you're going to cross-reference with the account numbers in the reference column. Okay. Any questions on that? Now the next part of it, you're going to have a third closing entry. Now this third closing entry is going to require that you determine the balance in the income summary account. So we're going to go back to the ledger, and we're going to figure out what the balance is. Since the credits are greater than the debits, we're going to have a credit balance, and the amount of the balance will be $3,200 on the credit side. So that would be the balance of the account. Does that number look familiar to anyone? Yeah. It agrees to the net income amount. $3,200 is what we have from the income statement. Okay. So this account, income summary, all it is a summarization of your expenses and your revenues to calculate your net income. Now, keep in mind, you will have a credit balance if you have a net income. You will have a debit balance if you have a net loss. So let me repeat that. A credit balance if you have a net income, and a debit balance if you have a net loss. So we want to close out this income summary account because it too is a temporary or a nominal account. Now to do that, we're going to have to force the balance to be zero. So that means we're going to have to put $3,200 on the debit side. So our next entry would require a debit to income summary of $3,200. And we will credit, what do you think we're going to credit? Yeah, you're right. Retained earnings. $3,200. Okay. So you're debiting income summary for the $3,200, which is the value of the net income, and you're going to credit retained earnings for the $3,200. Okay. When you post it, you're going to put the $3,200 on this side. That's going to bring your balance back down to zero. And now you're going to what? Post it to the retained earnings account. And you'll notice that we still have one temporary account out there that still has a balance. And that account is the dividends account. The dividends account is also temporary. So there's going to be one more closing entry. Now I ran out of room. You can't see below here. So what I'm going to do is just write it up here. And I'm going to have one more entry. It's going to be, what, December 31st. I'm going to close out the dividends account. To make that happen, I'm going to debit retained earnings for the amount of the dividends, which happens to be $800. And then I'm going to credit the dividends account because dividends has a normal balance of debit. So when I credit dividends, I'm going to decrease it and bring it down to the zero balance. Okay? And then again, yes, you got to post it. Let's go back to our general ledger. We're going to put our $800 on the credit side and $800 on the debit side for retained earnings. And that will bring our dividends down to zero. And our retained earnings is going to have what? 4,200 minus 8, 3,400. Credit balance would be our final balance. You will notice that retained earnings is not zero. After you do all your closing journal entries, you should normally have a balance in your retained earnings account because remember, retained earnings is considered a permanent account. You do not close out the retained earnings, you close to the retained earnings. One more thing just to kind of cause attention to it. This 1,000 was the beginning balance. This is the beginning balance of our retained earnings. This 3,400, this represents our ending balance. Okay? And if you were to look at the retained earnings statement for the same company, you'll see that they had a beginning balance of 1,000. Net income for the period from the income statement was 3,200. And then you had, let's see, a subtotal of 4,200. And then your dividends for the period was 800. 800 minus the subtotal, you came up 3,400 as your ending balance. So when you finish doing all your closing journal entries, your retained earnings should agree to the balance you have at the end of the period. So, in short, these are the 4 basic closing journal entries. Closing of dividends directly to retained earnings, close revenues to the income summary, close all your expenses to the income summary. This is a compounded journal entry. You're welcome to close them out individually. However, that'll take up more space as well as more time. Doesn't matter so long as you get zero balances in all your expense accounts. And then you will summarize your income summary in the income summary account, And to do this journal entry, that closing of the income summary, you need to know the balance. Once you know the balance, then you can close it out to the retained earnings.